What if I told you there's a financial market that's worth over $100 trillion? This market impacts your mortgage rates, determines how much your credit card APR goes up or down by, and the market influences whether you get hired or laid off. It even affects the price of assets like Bitcoin. Would you know what this market is? You might guess the stock market, maybe crypto, but the real answer? It's the bond market. And it's arguably the most important and most misunderstood piece of the entire global financial system. And if you don't understand this market, you will not understand money. Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, we're going to break down how bonds work and also why they silently control just about everything that happens in your wallet. So without further ado, let's get right into the video. So what exactly is a bond? Imagine you're launching a new business. You've got the vision, the hustle, the plan, but you just don't have the cash. So you go to someone who does. You ask them to lend you money. In return, you promise to pay them back with a little extra, and that little extra is called interest. It's the cost of borrowing money. And the reason it exists is because money today is worth more than money tomorrow. If someone gives you their money now, they're giving up the chance to use it somewhere else, maybe in their own business or maybe by investing it. So they want to be compensated for that sacrifice. Now, individuals and businesses borrow money all the time, but so do governments. And when they need funds, they don't go to the local bank. What they do is they issue bonds. So a bond is basically a formal IOU. When you buy a bond, you're lending money to the borrower. The borrower, whether it's a government or a corporation, is promising to pay you back later with interest. In this setup, the issuer is the borrower, the investor is the lender. The US government, for example, spends money constantly on defense, infrastructure, education, social security, healthcare, you name it. But here's the catch. The US government almost always spends more than it actually takes in, and that gap is known as the budget deficit. Every time we run a deficit, we're adding to the total national debt, which is the amount that the government owes for all past borrowing. Deficits are annual, the total debt is cumulative. So let's put this into context. In 2022, the US collected most of its money from taxes. 54% came from personal income tax, about 30% from payroll taxes, and only 9% from corporate taxes. The rest came from things like excess taxes, from park entrance fees, and things of that nature. But despite all of it, it still wasn't enough. So how does the government cover this shortfall? They do this by borrowing, and it borrows by issuing bonds through the US Treasury. Every time you hear about treasury bills, notes, or bonds, that's the government raising money from investors in exchange for a promise to pay them back with interest. And people tend to buy this debt. Banks, insurance companies, and even foreign governments also buy this debt. The national debt is just the sum total of all past deficits, which is the total amount the government has borrowed and still owes. As of 2024, the number has skyrocketed to over 36 trillion. And just like any borrower, the government has to pay interest on top of that debt. But why do investors, banks, pension funds, foreign governments, and even everyday American people want to buy these bonds in the first place? Well, because US government bonds are considered one of the safest investments in the world. They're backed by the full faith and credit of the US government. A default would be catastrophic for the entire global economy, so it's widely assumed that the US will always pay its debts. Now, let's break down the anatomy of a bond. All right, so first, there's the principal. The principal is the amount of money being borrowed or invested, and I have a figure right here that you can take a look at, for example. Next, we've got the coupon. That's the fixed interest payment the bondholder receives each year, usually expressed as a percentage of the bond's face value. Then there's the maturity, the date when the bond is due to be repaid. And finally, the yield. This is the actual return the investor earns from the bond. It's different from the coupon rate because the price of the bond can fluctuate in secondary markets. And yes, bond prices go up and down, but the coupon, the dollar amount paid, that will stay fixed. So if the price of the bond drops, the same dollar coupon now represents a higher yield. If the price rises, then the yield drops. Here's an example. Suppose you buy a $1,000 bond with a 3% coupon. That means you'll earn $30 a year. Now imagine interest rates rise and new bonds are being issued with a 5% coupon. Suddenly, your 3% bond isn't so attractive. So on the open market, it might now sell for just $900. But if someone buys it for $900 and still gets that $30 payment, their yield is now 3.33%. This dynamic means that bond yields and bond prices move in opposite directions. Now, I'm sure you're thinking, who decides these interest rates? Is it the government? Is it the Fed? Well, it's a combination of things. There are treasury auctions that play a really big role. The government sells bonds on a set schedule. Some are every week, some are every month, depending on the bond's maturity. This is called the primary market, and the result of these auctions set benchmarks for interest rates. Investors in the secondary market, where people buy and sell previously issued bonds, will use those auction yields to value existing bonds. But yields don't just move based on auction results. They also change based on expectations. Investors ask themselves, will the Federal Reserve raise or cut rates? Is inflation coming? Is the economy speeding up or is it slowing down? These questions shape how much return investors demand in exchange for lending their money. In other words, bond yields reflect what investors believe the future holds. And here's why this matters so much. When bond yields rise, it becomes more expensive for the government to borrow money. Remember, they're constantly issuing new debt and rolling over old debt as it comes due. A big chunk of the US government debt is in short-term treasury bills, debt that matures in just 6, 12, or even 18 months. That means the government is always refinancing. If interest rates go up, so does the cost of borrowing. It's like having a credit card where the rate resets every few months. That's why the government wants to lock in longer term debt at lower rates, just like you'd want to refinance your mortgage if the interest rates were to drop. But if they can't and the rates stay high, the more and more tax revenue has to be used just to pay interest on the debt. That leaves less room for everything else like defense, healthcare, education, and more. So hopefully you understand why when we increase the national deficit, it makes interest rates go up and how that can be a big problem later on. So now let's talk about how bond yields impact you. Right now, the US government has over $36 trillion in national debt that they have borrowed from the public over time. The key ratio to watch to get an understanding of what that debt really means is called the debt to GDP. It's a way to look at how much the government owes versus how much we produce as a country. It's essentially the same as how much debt your credit cards have versus how much money you can make annually, kind of like your debt to income ratio. This can give you a better idea of how healthy the debt is or how likely the person is to be able to pay off that debt within a certain period of time. If bond yields are rising, that means safe assets like government bonds are paying more. At some point, they start to look better than riskier investments like stocks. After all, if you can earn 5% from a US Treasury bond with virtually no risk, why take a gamble on a stock that might only return 6%? This creates something called the equity risk premium. It's the difference between the return you expect from stocks and the risk-free rate you get from bonds. When bond yields go up, that premium shrinks. And when the reward for taking stock market risk gets smaller, many investors move their money out of stocks and into bonds. That's why rising yields can cause stock prices to drop. But that's not the only ripple effect. There's also something called the high yield spread. This is the gap between yields on safe government bonds and riskier corporate bonds. If the economy looks shaky, investors get nervous. They demand more return for holding corporate debt. That makes it more expensive for companies to borrow and harder for them to grow. Wider spreads often signal that trouble is brewing. In this way, the bond market doesn't just reflect what's happening in the economy, it also helps shape it. And finally, we've got one of the most important signals in all finance, the yield curve. Typically, the longer you lend your money, the higher the interest rate you expect, which makes sense. If you're tying up your money for 10 or 30 years, you want to be paid more than if you're lending it out for just 6 months. So under normal circumstances, long-term bonds pay more than short-term ones. That's called an upward sloping yield curve. But sometimes things flip. Short-term yields rise above long-term yields, and that's called an inverted yield curve. Now, why would this happen? It usually means investors expect interest rates to fall in the future, often because they're anticipating a recession. When that happens, investors pile into long-term bonds to lock in yields before rates fall. That increased demand pushes long-term bond prices up and yields down, causing the curve to invert. And historically, an inverted yield curve has been one of the most accurate predictors of coming economic downturns. So yes, the bond market is that powerful. It affects your mortgage rates, your car loan, your job prospects, your stock portfolio, and even what the Fed is going to do next. And yet, most people don't even know how it works. And if you understand bonds, then you'll understand money. And hopefully now you do. I want to thank you guys so much for watching this video. In the next one, we're going to explore how the Federal Reserve and Treasury actually influence interest rates and manipulate the yield curve, and how that affects everything from inflation to employment, If you guys want more information like this on a daily basis, please join My Success University. There's a link in the description. It's a community where you can enhance your financial education, and it goes beyond just the basic financial literacy that you normally get on YouTube. Once again, thank you for watching, and remember, while most people are focused on what's flashy, the real power is often in what's hidden and what's boring, and there's really nothing else more boring than bonds. So if you really enjoyed this information, join My Success University and look out for the next video.